All right. That conversation is going to keep going in the TC Plus Lounge, but we have one more panel for you today that I am ridiculously excited about because it's all about making money last. But before we get to that, a reminder, of course, we are doing Q&A. Microphones are there and there. So for the next panel, if you have a question, write it down, and we will get to you in a few minutes. Now, if you raise $1 million and you spend it, you no longer have it. And if you raise $5 million and you spend that, you still don't have it. So a good question in this more conservative venture capital market is, how can you make your venture capital money actually last? So to cap off this fine day, we have TechCrunch's Walter Thompson, we have Anamitra from Afore Capital, we have Frederique from GV, and Rick from NEA. Give them a warm welcome.
Oh, it's very bright.
Thanks very much for joining us today. Okay, so I really should have given the event team a more recent photo. I apologize. That beard looked like a folk singer or something. So today we're going to talk about how to stretch your venture dollars. Our panelists you've been introduced to. I'm going to ask each of them to kind of go through their investment thesis really quickly to kind of set the table for the conversation. Starting at the end, Rick, you can go, please.
Sure. So I'm Rick Yang with NEA. We've been around for about 47 years, about $25 billion under management. Very much a diversified venture firm. So we do both early stage growth all the way from seed to pre-IPO type investments across all sectors within tech and healthcare.
I'm Frederique. I'm a general partner at GV, Google Ventures. We are a stage agnostic and category agnostic VC firm with a sole LP Alphabet, and even though Alphabet is our sole LP, we're not strategic to Google. And we have $8 billion under management, and I'm excited to be here.
Hi everyone, I'm Anamitra Banerji. I'm the co-founder and managing partner at Afore Capital. We've been around about 7 years. We exclusively invest in pre-seed stage companies. We started off in 2016 with a $47 million fund, and the most current fund is our third fund, which is a $150 million fund. And we typically invest in companies, and most of our pre-seed companies don't raise very much. So this topic is really top of mind for many of them.
So I'm going to start with a show of hands here, actually, the audience. Can we see a show of hands? How many people here are working in angel or seed or pre-seed companies, startups? Okay. Series A, hands please. Series B. Okay, so a very, very early stage crowd. Good to know. Thanks for participating. Starting the questions with the investor perspective. First order of business, and starting with you, Rick, expressed in months, what's a decent runway for an unprofitable, pre-revenue, seed stage startup? Put another way, when is it time to start raising your next round?
Oh, that's a tough question to answer. I mean, I think of it as sort of pre-product market fit and post-product market fit. Because pre-product market fit, you want to have as much runway as possible, in my opinion, because that's really the goal of being a seed stage startup. And until you can kind of prove that product market fit, whether it be through monetization or adoption and engagement, depending on sort of what type of company you are, I think it's really hard to go out and raise that, call it Series A type of company, and feel like you're benchmarking well to those things. But even when you're showing product market fit, I think the goalposts have sort of changed, right? It used to be, maybe you have 6 months of runway left and you go and raise your next round. Now, again, more is better because of the market being a little bit more volatile, and it's hard to tell really how long a fundraise is going to be, and you also don't want to sort of be forced into any sort of situation when you're fundraising.
Frederique, anything to add to that? Or?
Do you want a number?
I mean,
No,
I don't really want a number, but I think it's one of those things where like it would settle like anxiety if people had a number they could shoot for or work towards.
I agree with Rick where he said that we need to have as much as possible. Like it used to be 6 months, and then you would raise within 1 to 2 months, and then be set up for the next round. This is much trickier now, and I think if you don't have the right vision and the right unit economics, it's really hard to raise the next round. So you need to be very mindful about what type of KPI you're driving. and targeting, and really understanding what is the fundamentals of the business and what's your path to profitability. It's crazy to talk about that at the Series A level, but I think there is a way where you may need to sustain the company indefinitely if you cannot raise. So this is really an exercise of building relationship with investor early on, building great partnership with investor, so when you set up to raise, it makes it easier for you, and you understand what are the expectations in terms of metrics you need to hit to be able to raise the next round.
Yeah, I think just looking at our portfolio of the last 7 years, 80 plus companies who raise a pre-seed, and majority of them try to raise a Series A, and the common pattern is around 18 months. It allows you to make a number of tries without over-hiring, pivot if you need to essentially figure out the first 5 customers, a pathway to $1 million ARR, and so on and so forth. And the other number that I see a lot from companies is they want to make sure they have at least 6 months of runway, at which point they definitely do start fundraising. So you're kind of aiming for a 12-month, and with a 12-month low burn, to ensure that you actually have something that people want. That gives you plenty of time, lots of iterations, lots of twists and turns. Those are the 2 numbers I see.
Are you seeing companies doing smaller rounds more frequently, or?
I think founders in general would like to raise the largest possible round in the shortest possible time. And that's what they prefer. So if they can get that done quickly, they would rather do that. But I think there's a lot of capital available now, just from angels or just from pre-seed or seed funds. So getting to $500K to $2 million is very achievable in a couple of months time frame.
I know revenue is a key factor. This is for you, Frederique. But what's an acceptable burn rate ballpark for an early stage SaaS startup? I've heard like the range of like maybe 50K a month, but I'm not sure if that's true. What's your sense of that?
I think it depends on the cash you've raised, what type of size of capital you have on your balance sheet. I think it can go from 50 to 200K easy. I would say the smaller the burn, the better. And the better path to profitability, the better. It doesn't mean you need to be profitable, but knowing what are your levers to get to that point if you need to, and you need to extend runway, is very, very important. And I would, as a former product person, I was formerly at Uber, it's very important to focus on what's very necessary within your company versus what are the nice-to-have products. So really focus on your core value proposition and make sure that you don't overextend your team or yourself into multiple type of product lines.
Actually, this is for the entire group, for the entire panel. When you're talking to a founder, do you expect them to know their burn rate off the top of their head? Rick?
Absolutely. I mean, I would expect them to be checking that cash balance pretty regularly, kind of knowing it off the top of their head, what it is. That's really sort of the lifeblood of the company at the earliest stages. I mean, cash balance, burn rate is one thing, but the reality is, when I'm talking to an early stage founder, it gives me a lot of comfort when they have basically thought about and are marinating and are obsessing over every aspect of their business, right? So they've at least thought about everything. They may not have the answer to everything, but like they've at least like touched on it or thought about it. And to me, cash should be top of mind.
And also understanding how your burn is going to evolve over time. I have some companies who have some strategic opportunities where they need to build more products or they need to build an additional feature that can have an impact on your cash and your burn. And so understanding, I'm a big fan of reforecasting or remodeling your financial model if you have new opportunities to understand how it will reflect in terms of cash runway. Yeah.
I think founders absolutely need to know burn, like everyone's saying. I think importantly, they need to understand the difference between gross burn and net burn. So if they're making revenue, then take that off from the gross. And if it's repeatable, then you can project a little bit forward. I see most founders to be fairly paranoid about burn, how much they're burning, how much it's going up, and where that burn is coming from. Sometimes it's legal fees, which is one-off, that won't happen next month, but it's the recurring ones that keep piling up. Most of it is headcount, and people tend to overhire ahead of the product. Sometimes you have to, if you find a great candidate. That's usually, staying on top of that, I think, is really important.
I mean, are you seeing, anecdotally, people cut back with things like, exaggeration, maybe a joke, but like the mahogany foosball table, are these expenses still being offered, or are they going away now?
I used to work at Twitter a long time ago, and I think we had $1,000 Polycom machines in every single conference room that never got used because people use their cell phones. So I think as companies get bigger, I think the bar drops a little bit, but I think companies at the very bottom, who I think founders tend to be very frugal anyway. They don't have a lot of personal burn for the most part. They tend not to be spending too much money on anything out in SG&A, anything outside of like their software or their people.
I do think one of the things that's top of mind for a lot of companies right now, specifically in AI, is there's a lot of upfront capital going towards hardware and GPUs right now. So that's completely throwing off sort of the notion of what should a seed stage company be burning. And that's something that I would also expect founders in that space to really understand and be able to communicate sort of what the strategy is, how that dictates capital raises down the road, what the ROI is that you're getting out of a lot of this infrastructure that you have to build up front, because it is expensive.
It's funny, I heard a partner was telling me just today actually that LPs should just give money to NVIDIA directly. Just give it a cut out the middle.
Yeah.
So
One thing that is I think all venture funds do that very few venture funds get credit for, and many other companies do, is they give away a lot of credits. A lot of credits, AWS credit, Azure credits, all sorts of software that you need to run a company is given away for free. I think Brex does it, Ramp does it, everyone else does it. That kind of adds up to around, I don't know, maybe $500,000 in a like totally equity-free money for the most part that a lot of founders can benefit from.
That's great. Actually, that was a question I don't have to ask now as far as venture discounts.
Sorry.
No.
I would say same thing with marketing. Like we give as investor a lot of money to Facebook. And I would say really understanding what is your marketing strategy or go-to-market strategy. For consumer, it would be what are your channel, paid channel versus organic channel. And the faster you get to more organic growth, the better you can prove your product market fit. So this is really important to understand how you can build sales efficiency or go-to-market efficiency to spend as little money as possible when you can.
Do you coach, or do any of your firms coach founders with Treasury Management or system in any way?
We do as part of being a board and understanding. I think SVB was a big catalyst to doing treasury and understanding how you do treasury management, but I think it's more on an ad hoc basis.
Yeah, we've kind of built out some best practices that we try to share with all of our portfolio founders and CFOs and CEOs, but it really is different for every stage of company. But a lot of it is, these startup companies raise a lot of cash up front and then sort of burn it down over time. And the CEOs and the teams want to be focused on building product market fit and talking to customers and really kind of being engrossed in the building of the business. And so the more you can outsource and reduce the risk of anything happening to that cash, I think the better, right? So we just try to provide some guidance around that.
Just like Frederique mentioned, like until March of this year, Treasury Management was not something that anyone kind of looked at. I certainly didn't. But since that time, I've seen founders in our portfolio like dabbling into U.S. Treasuries, taking a portion of their cash and putting into very short-term U.S. Treasuries, earning yield and interest, and that's kind of interesting to see later on. But then some founders gamify it a little too much, and they spend a little too much time on that, and now they're like they spend too much of their time looking at that. So maybe that's not required. But I think there are some good options outside of thinking of just leaving in cash, maybe in short-term treasuries.
As long as you don't report it as ARR, you're fine.
That's right.
So a follow-up actually. So. Whose job is it to, I think I know it's the CEO, but is it primarily the CEO's job to manage Runway, or is it a shared responsibility?
I think in the beginning, until companies have a finance organization or a CFO, and maybe that doesn't happen till Series B or maybe even Series C, it's all the CEO's job. It's complete. The CEO's job, I think, is number one, to make sure they don't run out of money. Like number one job, and then ensure that everything else works. You get to product market fit, you hire. Don't run out of money.
And I think there is a partnership with the different C-level people within your team. I know I'm an investor in a baby monitor called Nanit, and there is a big effort from the CFO to understand inventory management and payment terms to really understand how you cannot have too much working capital So that's something that you want to have all your people within the CEO organization be accountable for making sure they optimize their cash efficiency.
I also do think that the board plays a role in cash and runway management and just understanding the landscape, providing feedback and perspective on, hey, we've seen this happen, let's make sure we take advantage of these credits, as we were mentioning up here, just to make sure that, again, anything that feels unoriginal to making sure that a startup runs smoothly and you can minimize as much risk as possible is sort of shared, and all of that goodness is just handled in a very efficient manner.
It's like drilling down into actual money-saving tactics. And here's my first question. And forgive me, I've asked this question to a lot of different VCs, and I've never really gotten what I would call a straight answer. How much should a CEO of an early-stage software startup pay themselves? Rick.
It's a.
Please don't say it depends. Don't say it depends.
It's a very personal sort of decision, right? Because in some sense, we can give data that shows what the averages are and as much benchmarking as possible, but every situation's a little bit different in terms of that individual and where they are in their life cycle and sort of what their needs are. It's a balance between A, runway of the company, and B, making sure that that CEO or that executive is comfortable and doesn't have to kind of stress about things outside of the day-to-day stresses of maintaining and creating and growing a startup, right? So that's why it's really hard to answer a very specific number. But to me, it's finding the balance and just being very transparent about what's needed and what's not. And you can generally tell as either an investor or a board member that somebody's being really thoughtful about it, right? And understanding that, this is about the survival of the company. And also, I don't want to be sitting there, trying to make product decisions and talking to customers and worrying about paying rent.
Yeah.
I find CEOs generally take a pay cut to start their company. They're usually underpaying themselves for quite a considerable period of time relative to what they could be earning at a FANG or somewhere else. But they also obviously need the cash to make. They shouldn't be worrying about the basics. At the same time, most of their comp is in their equity. That's what really is the moneymaker for them. And sometimes some founders eventually, if they have an oversubscribed round, are able to do secondaries for example, not to worry too much about the rent or put some money down into a house, things like that. I haven't seen significant excesses from founders. And also being too frugal on yourself is probably not the right path either. There's probably some balance in the middle. But usually the executives get paid more. If you look at a table of everyone at the company, the founders are usually taking less than the salesperson or the head of product or another executive for the most part.
What are some near-term revenue opportunities that you've seen move the needle? Things like, are pilot programs a viable option for lead gen? It takes time to roll these things out. So if you're in a hurry, you need to actually scoop up some revenue quickly. What are some things that a person could do right now without having to break the bank or hire a whole new team basically?
One thing I've seen is because many companies who are just getting started, it's taken them quite some time to build a product. Now they have to start to sell it, and selling takes some time. What they often do, sometimes what they do is to bring in some cash, they do professional services as part of the sales process, where they get, you can think of it as like consulting almost. The company is selling to a customer, the customer is paying the company for 2 months to implement the product. This way, the company is making some money and also potentially getting a customer that will pay them for software eventually. That's one way to sort of roll in the revenue. Another thing that many founders do is instead of worrying too much about enterprise sales, where the sales cycle is very long, they sell to smaller businesses who make faster decisions, maybe not for as much as large an account size, but they're willing to commit faster and bring in contribute to revenue faster.
And I think it's also the idea of not being stuck into your eventual business model or go-to-market, and be very creative of what will get you to survive or to extend runway and to generate revenue before the long-term game is in place. Like you said, finding ways to monetize by selling seats versus one charge fee versus selling by seats, so you can really get the product in people's hands and still generate revenues without being it a big a big expense for the companies you're piloting with.
Yeah. And I haven't seen a company that has a product that customers want in a big market and the founder is able to explain that market that may not be making a lot of money fail to raise a round. If you can prove that there is a market, even though you're not making a whole lot of money, you can extend runway by raising money. The investors are looking for breakouts, and they're not really investing just based on the revenue today.
Yeah, I'd add two quick things. I mean, I think one is like, ask your customers for money, and the worst thing that'll happen is you'll learn a lot about your product and your value proposition and where you may be resonating, where you may not. And on the flip side, if they say yes too quickly, you probably know you're also underpricing it and you've got something great on your hands, right? So it's never a big deal to ask. And the reality is, most of your customers, whether they be consumers or even enterprises, understand that a startup needs to kind of figure out monetization and sustain themselves. And they're not going to ding you for asking, even if it's one of those things where they're like, look, we don't have the budget for it, or it's not quite there yet from a product standpoint, but at least you'll learn. And I think the second thing I'd add is there was a period of time where I think people really pushed back on these ad-supported models or sponsorship-supported models. And what you've seen is, even take the example of a very top-of-mind company like Instacart, right? And seeing how they've really transformed the economics of their business. Most of their customers have no idea how much of their business is driven by ad revenue, and frankly, like even their investor base is driven by some of these strategics. So you can always start to think about different monetization models that may or may not be in vogue, but the reality is, like, at this stage of company, you're really just testing what works and see who's going to pay you.
A question for you, Frederique. How would you start the process of refocusing a business, or pivoting, I guess?
Yeah, I think that it's very easy to get distracted. I know when I was at Uber, we had the rider side of the business and the driver side of the business, and we had a product team for each one of those pillar products. And as a CEO, you want to be very involved in understanding what makes sense for your business. And I know Travis, when they came into the room, we had a roadmap for riders and a roadmap for drivers, and he realized, like, scratch everything riders related, and we're going to refocus on the driver side of the business so we can avoid surging, because we are surging all the time. And he said, I don't care, it was 2012, and he said, I don't care about lost and found. We can do it manually, and we can have a bag of all the lost and found and have people go through it when someone has a request, but we really need to get drivers on the road. And so having a fundamental understanding of, if it's a marketplace, what's driving the business? Is it supply or demand? In that case, it was a supply of drivers. And really focusing your energy on what makes sense to build that marketplace, and knowing that once you have the driver on the road, you can actually get people to come and order a car, is critical to your business. So as a CEO, you really want to understand what makes your business grow and what is critical for getting the demand come onto your platform. And then really put all your resources on that. If Travis had been removed from that part of the product and had just let us do what we wanted to do, we would have had a bloated team focusing on a rider roadmap and a driver roadmap, and we would have probably burned twice as much as we needed to, when it was actually making more sense to just focus on the drivers. So really having a good pulse on the business, understanding what makes the business hum, and is very important. And so you want to be very involved in the day-to-day and understand what makes your product tick, and then refocus your resources into that and remove any ego. It was very hard for the team to scratch an entire half of the roadmap, but at the end of the day, you really want to do what's right for the business. And in that case, the rider side of the business, the driver side of the business was a critical one.
Thanks. Question for you, Anamitra. You helped start the ad platform on the site formerly known as Twitter before shifting to VC. The platform's new owner simply decided not to pay many vendors to save some cash after buying the place. I'm not sure if that's advisable. Have you seen founders effectively negotiate lower fees with landlords or vendors? Is that something that works? Is it a practice?
It's not a bad idea to renegotiate if you can. I think in most companies, most of the burn comes from people. That's probably 80 to 90%, and the rest of it comes from vendors or software that they buy. I think with AI, I think that might be going up because of the token rates, etc. They do. I haven't, but this is a dramatic example where you stop paying someone. I think that might be what you do at the end, perhaps to extend your runway, where creditors line up. But I haven't seen that all that much.
Okay. Actually, and that's a good question. Like, talent is the biggest expense, obviously, and the first place people usually start cutting. Without getting into the whole like how to manage layoffs, how do you sense when it's time to start cutting positions? And my follow-up question is, do you right size for today, or do you just cut and feel the pain? Rick, start there.
Look, I think this is a tough topic. I think taking a step back, the earlier you can make these decisions and punch above your weight class in terms of feeling resource constrained and performing at a level that with a small focused team that a bigger team couldn't, I think that's sort of like the best place to be in, right? So the earlier you make these decisions to really be efficient as a team, the better, because then you hopefully don't run into these situations. I think the reality is, if you kind of look at the situation that a big part of the market is in right now, it happened because a lot of forecasts changed, right? And so companies forecasted a certain amount of growth, built up resources, built up people, built up teams to hit those forecasts. And then a lot of things that were either, a lot of things that were outside of those companies' control, some of them inside their control, ended up happening, and you had to reforecast. And then sort of like the existing structure of the company just didn't make sense for where the business was going. There was a period of time where, from a capital market standpoint, a lot of companies were able to raise capital in a fashion that was very different than sort of what the business looked like today. And so you could raise a round that looked like a traditional round that would have been for a company sort of like 2 years down the road from where you were. And then people would build out their companies to look like what a company that had raised that much money was, without necessarily kind of doing the fundamental analysis of like, where is our business today? What's the right size of that team? And so once you find yourself in a position where, plans change, things change, you have to make a lot of those hard decisions. And the longer you wait on those, I think the more painful it is. And frankly, the less runway you have to benefit from making those hard decisions.
I'm a big fan of scarcity breeding innovation. And so I'm a big fan of refocusing and focusing on your core product and your core need and removing any distraction of nice to have, because it's human nature to fill in a void. If you have more resources and you have more product ideas, it's easy to hire and overhire. And sometimes refocusing your effort into your core product and being very disciplined, and maybe you realize that you didn't need this other product on the side, and you want to be known for one thing, and that one thing I know at Uber was being known for being a transportation company versus Uber Eats, Rush. It came after, but we wanted to be a platform that was focused on transportation. And I think that it's very important to be scarce in how you're building your business, and to be and it helps with agility, it helps with understanding if you need to pivot, it needs to understand where you should hire better, and refocusing your strategy sometimes for the best of the company. So I think that this is something that companies are always afraid to do, and they always do it at the last minute, when it actually takes discipline to go through that exercise earlier rather than later.
Yeah. It's generally harder to do as the company gets larger and larger. It's just the cost is larger, the emotions are greater, number of people are impacted are greater, just the planning process is much busier. I know people suggest you should just cut, very deep cut once and that's it. But I don't know how practical that is sometimes. I think multiple cuts sometimes are unavoidable. I have seen something happen at the seed stage at least, where companies that went from 20, 25 people, and they began to struggle mostly because their product had some product market fit, some revenue, but it wasn't a roaring success. And founders at that stage have made different decisions. They've either sliced off a piece of the team, and in other cases where the company has gone down to saying, no, let's go back to being a root, like a seed stage company, just 3 founders working on an idea, but working on maybe a radically different idea with the cash that I have. And that requires a lot of investor support for a drastic situation like that. But I think investors get involved to help founders through this process.
I will get some audience questions, but I had a couple of more I want to get to. I met a founder yesterday in the hall, a biotech founder from Bay Area, and he was looking for more funding because he was already capitalized, he had a lab, he had built, he had equipment and everything, and he said he was weeks away from actually being able to capture revenue from customers. Unfortunately, a fire burned down the entire facility, which included his home and his brand new Tesla. So he's lost everything. And so he's here looking for investors who can help him get recapitalized, get back up and running. SVB might not be a magic wand in this situation. What would you advise he do in a situation like this? Rick.
I would say first and foremost, if he's taken funding already, to make sure that he's built that relationship and has been very transparent with his existing investors, because that's going to be the deepest relationship and source of understanding of sort of where that company is, the execution, and understanding that like this is a completely random sort of external event that happened. So that's where I would start. And secondly, there is a little bit of a debate over how much time you should be spending with investors that aren't in your business when you aren't fundraising. And my view is, as a founder or a CEO, your job is to make sure that your business is capitalized. And part of that is maintaining relationships with investors, probably not spending too much time on it, but making sure that you have kind of a core base of people that you get to know, that get to know you, that get to see sort of those data points along the way. So when something unexpected happens, either on the upside or the downside, and you're sort of in a crunch and need to raise capital to grow the business, that you'll have a stable of folks that you can call on.
And there's some creative way to get funded. You can have a tranching way of doing it where it's tied to a milestone. So you maybe, I need to start from scratch, but I'm going to go faster on phase 1. And so there is a way to say, you can get financed and have a tranching structure where you can have 5 million up front and then 5 more million when you reach a certain milestone. And in that case, you may go to that first milestone much quicker because you've done it before. So there are always some creative way to do it. I wouldn't advise to use debt too much. I think a lot of companies that have taken on debt and living on debt, running their business on debt right now are in a bit of a tough situation, because if you cannot raise an external round, it's only internal because the market being what it is, it can be really tough to refinance your debt. A lot of debt creditors are really focused on being able to renegotiate if you have external validation versus internal validation from your insiders. And it can prevent you from getting into an M&A transaction, because a lot of acquirers don't want to inherit that debt. So I think that you need to be also very careful in terms of, do you want to secure debt in that type of situation?
I find that successful fundraisers from founders usually emanate from a position of strength. When the founder feels confident, excited, and optimistic about the business, they can present a very positive picture and get everybody excited, because it's a sales process for external fundraising. But when the founder has had a tragedy, when they're they're on the ropes and they're trying to survive, I think at that point it's very hard emotionally to present an optimistic perspective about the future and so on, or make a very compelling, confident case, because you're not at that place. At that point, I find that it's angels and the friends of the founders who actually believe in the person, who have some context, could be insiders, could be friends, could be angels, to put together a sort of like a bridge or an extension or something at an economically attractive price, something just to get the ball rolling, to buy 3 more months, 6 more months, so that you can get out, first of all, this emotional doldrum, and then position the product, and then rebuild a little bit, and then go out and raise and get yourself to be in a position of strength. But I think immediate bounce back, immediately getting back on the horse is a little bit harder.
Thanks. We have time for some questions. Is there anyone in the audience who's ready to ask a question? There's a microphone set up, I believe. If not, we can turn right back to the... All right, I guess we're going to go back to the prepared questions. That's fine, too.
Oh,
I think so.
Oh, I'm sorry. There we go. Yes, please.
Hi. So I have a question when it comes to first-time founders. How do they spend their time between user metrics, product market fit, on tools that promise to deliver retention, like Mixpanel or Hotjar? I'm not sure if you're familiar with the question I'm asking. Like, how much time do you spend on like creating your own Excel sheets and own data versus using some other third-party tool?
Versus what?
Versus a third-party tool.
Yeah.
Oh.
I think there is some, it's basically measuring the business analytics to see if your thing is working or not. I think there's some free versions of these products, even Google Analytics. It depends on how specific and custom you get. I think another thing to think about is free credits you might be able to get, maybe startup programs that some of these companies have, like Amplitude. I'm not sure if they have it or not. There are some open source versions of these same products that are freer and cheaper. Generally for analytics, I find that for the base cases, it may not be very expensive. I wouldn't over-rotate on analyzing the data unless unless you've figured out exactly what the journey of the customer is, what the journey of the user is, and what you want to optimize. In the beginning, it's just a binary switch to figure out if people are coming back and if they're using the product or not. I find that value of a lot of deeper analytics is about optimizing that journey, tweaking that journey. So maybe not too much time, just enough just to collect the basic data to see if there is any interest or not. Another thing to do is just speak to the customers directly if you can, more than just looking at the data, because sometimes they're not using it in the way you wanted to use it.
I think I like that question a lot because a lot of founders are not focused on measuring and having dashboard. I think one of the strengths of Uber is that we had dashboard on day one. And you want to be very disciplined about first understanding what type of KPI you want to measure. It's like it's very easy to have a lot of dashboard and a lot of data, but you need to get what matters. And sometimes it's easier to build your own dashboard with these right metrics. But finding a trade-off where you don't need to invest too many engineering resources and cycles into building your own dashboard is very important. You want to focus on your product first, and if you can outsource that to tools that already exist, great. But really having the discipline to understand what type of metrics you want to track is actually very, very important, because we are bombarded by data every day, but you need to understand what actually matters.
If we're quick, I think we can get to 2 more questions.
I just have a quick follow-up.
I'm sorry, we really need to get to as many people as possible, but thanks. Maybe
Yes.
afterwards. Yes, on this side over here.
One thing we've done to extend our runway is build a remote first team, and in particular hiring talent overseas as well that are at a lower cost basis. And so I'm just curious, from an investor standpoint, how do you all think about remote first companies, investability of that, companies that have globally dispersed teams vis-a-vis companies that are like fully locally based in the same office together?
I think remote first can be great for hiring the right talents that is not tied to a geographic location, and also cheaper talent. I think the issue is when you're building a company, especially a very early stage company, is that you're losing a lot of momentum in terms of development cycles, feedback loop, and iterating. I have a lot of my companies who started as remote first during COVID who are now trying to get back to the office, and it's incredible how much velocities are gaining by just being together, even just 2-3 days a week. So it's a tough one, but I would say finding a middle ground between being full-time at the office and not at the office at all is something you need to embrace. Is being at the office the same days, a few days a week is actually critical to really test your product market fit, have teams collaborating, and really have great velocity within your business.
Yeah, a lot of it comes down to what is the culture of the company? Is that conveyed out in sort of the velocity of shipping, iterating, kind of collaborating, and from an investor standpoint, being able to feel that, see that, if it is remote first, because it's just harder. That's just sort of the fact of the matter. It's just harder to see that as an investor when, you know, you're kind of like meeting with people over Zoom versus going into an office and seeing people kind of interact right in front of your eyes.
That is all the time we have scheduled for today. Thanks very much to the entire panel for the great conversation. I'm sorry we didn't get to more of your questions, but if you see these people in the hallway, feel free to be bold and ask them your question, and maybe they will have time to get back to you, hopefully. Thanks again. I'll see you all.
Thank you.